I'm Owen Bigland. This is the Inside Edge video blog. Okay, give you a couple stories, frontline stories, investment stories. It's Saturday here. As you guys know, I was away. I finally got away a bit at the end of last year for Christmas. I was down in Scottsdale, Arizona for a bit, in Los Angeles. And whenever I'm traveling, I usually meet some interesting people there at the Phoenician in Scottsdale. Nice resort. Met a couple interesting guys at the gym where we had a lot in common. All three of us were into real estate and investing. And stock investors as well. And as it turns out, talking at the pool, had a lot of the same companies we hold and the ETFs and some interesting conversation. We were all early risers. I'd see them in the morning at the gym at 6 o'clock and working out, and then see them at the pool later on. But got talking with a couple of these guys, and one of them told me he's been like myself, investing in rental properties, bought his first property 20, 30 years ago, and has been building up a portfolio. He owns some detached homes as well as some condos. And he said, the main attractions for him for real estate, diversification, because he's also a stock investor like I am, so he wants both. But, he said something, I've heard this before, the main attraction for him was the lack of liquidity, meaning that it's incredibly expensive and takes time to sell your real estate holdings. And that was what actually attracted him to it. It helped him stay the course. And I've heard many people tell me about this over the years. That's, they've gotten into stock investing, but it's too quick. They start getting into trading and buying, and they buy a stock and it goes down 20% and they sell it at a loss. You can check those stock quotes 5 days a week. It's flashing across your screen. Whereas real estate, you don't really see it. You buy it, you put a tenant in it, and then just let it be. And it is lack of liquidity, especially when you're in Canada. As I've talked about many times, the friction costs of buying real estate as an investment are extremely high. They're 100 times more expensive than the stock market. You've got the PTT on the way in, which is the biggest tax grab known to man, never been adjusted for after 30 years. They're drunk on the revenues with it. You've got perhaps GST if you're buying something new. When you sell it, you're going to have commissions of $30,000, $40,000, $50,000 to sell the home. I mean, if you buy a typical one-bedroom condo in downtown Vancouver today and want to sell it next year, you're going to need that condo to probably increase by $35,000 or $40,000. That's a one-bedroom. If it's a two-bedroom, you're going to need that condo to go up $70,000 or $75,000 just to cover your friction costs of getting in and getting out. So for that reason, you don't get in and out. It's what I've been telling you here. Real estate, it should be viewed as a long-term commitment. You buy it, you enjoy the home, or you put a tenant in it and keep it for 15, 20, 30 years and let your tenant do all the heavy lifting. The other thing, of course, we talked about, and I've told you guys many times, is leverage. You use the leverage. It's the real wealth, how most people have built their wealth, myself included. You buy a property for $100,000, let's say, you use $20,000 of your own, borrow the other $80,000 at a favorable interest rate, and the interest is all deductible from the income that your tenant gives you. It's a really simple formula. I go into great detail with it with my book, but we talked a little bit about using leverage as well. But we talked a lot about the stock market, and, we've gone through another vicious sell-off here back in January. The NASDAQ got into official correction mode there. It was down roughly around, the triple Q was down about 14%, maybe closer to 16% at its all low there. S&P 500, it also went into correction mode, went down just over 10%, and the Dow. A lot of it was, we've been talking about it now for a year and a half, that the Fed is eventually going to start raising interest rates. A lot of those interest rate hikes had already been built into it, but of course, once you start making an announcement that they're coming next month, then everybody's sold off. We were talking about that too, how, as an individual investor, yes, do you want to be paying attention to interest rates and the Fed and the economy? Of course. But for most of you, you can ignore all that stuff. It's not going to make any difference to your portfolio. Instead, what you should focus on is the companies you're buying. Don't lose sight of the fundamentals. You're either index investing, you own the S&P 500, or you own the NASDAQ 100. You buy it, you keep it, you reinvest the dividends and put more powder in as you go. As you're earning money, try and set aside 10 or 15% a month. And when you get those corrections, which are usually overdone, and this one in January definitely was. You get a lot of panic selling. You get a lot of what they call weak hands. If you were following me on Twitter, I was mentioning a few things on it, how I was buying and how I love these sell-offs because I'm still in the accumulation stage. I could have retired a long time ago and lived off the income my portfolio produces, but I still love my work as a working realtor. Therefore, I'm able to put money away every week from my commission checks back into the stock market. Plus, I've got a big enough portfolio that I'm, well into six figures every year in dividend income. So every month I might have $15,000 or $20,000 coming in fresh dividends, which I put to work. So I've always got dry powder, and I love these 10, 15% corrections. It allows me to buy companies that are on sale. It's one of those things. If you like Apple at $180, you're really going to like it at $155. And that's the way I look at it. And that's the way you guys should look at it too. These corrections are usually overdone. And if you're a long-term investor, these are just blips in the radar on your way to incredible returns. But, professional money managers and hedge funds and private equity running, hundreds of millions of dollars in portfolios. Sure, they're going to worry a little bit more about interest rates and the Fed because they're traders. They're getting in and out of the market continuously. They're churning the portfolio. They're not buying a company like Apple and keeping it for 20 years. Some are, but for the most part, they have to continue to churn that portfolio because their goal, in order to get those outrageous fees they charge these people, is they're going to tell them that they can outperform the index, the S&P or the Dow or the NASDAQ. And that's the dirty little secret that I've talked about many times on my blog, and I talk about it in my book. These guys at the Phoenician pool, we were all laughing at that too. How it's always going to be a stock picker's market. Every year is going to be a stock picker's market. That's what these experts will tell you. You need me. I'll charge you 2% plus a whole bunch of ridiculous fees and trading costs because I'm going to outperform the indexes, and they're not. They're going to get left behind every single year. The numbers came out just recently in the Wall Street Journal, just like every other year. Only about 15% last year of the professional money managers managed to match or beat the S&P 500. The other 85% were either, missed it, were below it, or in some cases way below what the returns were in the S&P 500 last year. So why would you put your money with these guys? They're charging you 2% for the privilege of underperformance. And they'll always underperform. Even the ones that by some miracle, and there are a few good ones out there that have consistently edged out the S&P. However, you do not have access to these guys. And for the most part, most of the 15% do it for a year. They get lucky. Maybe they get lucky for two. But they're not going to beat it for 20, 30 years consistently. Ask Warren Buffett, the greatest investor of all time. He will tell you the facts. My friends in New York, you go out and put a few beers in these guys, and behind closed doors, they'll used to tell me the same thing. Do it yourself, just index invest, or if you have an interest in it, sure, start buying some individual stocks. You're going to get a little nicer yield than the index will pay you. And I use a barbell approach. I want some growth, but I also like dividend growers, companies that pay a dividend increase and keep increasing that dividend. Because my goal when I finally do decide to retire, even though I could have a long time ago, I talk about it in my book, you hit that crossover point where you get a big enough portfolio that you never have to sell a share. You can comfortably live off the dividend income, and even better, that dividend income is going up 8, 9, 10% every year, which is far better than inflation. My dividend growth rate last year on my portfolio was something around 11%. We've had some incredible dividend increases here. A lot of the companies I'm holding, the Canadian banks, UPS yesterday increased their dividend 50%. I'm getting lots of, between 10 and 15% dividend bumps. Inflation's running at 5%, and my dividend increases are running threefold. You'll never run out of money. Buy my book. I talk a lot about just living off your dividend. You'll never have to sell a share, and your income is indexed to inflation by threefold. So stop. Most most of you that I'm talking to here, you don't need to be focusing. Instead, focus on the companies you're owning. Buy the index and hold it, or buy the Apples or the Amazons or the Johnson & Johnsons if you want to learn about these companies. You know, when I buy a company, I'm buying it for the long haul. I know that if I buy, 100 shares of Visa today, 6 months from now, it could be down 10%. But you ask yourself, you look at the fundamentals of Visa. Is that business going anywhere? Are people going to stop using credit cards? I don't think they are. It could happen. That's why you have a big enough portfolio that's diversified, because you are going to get a few companies that will fall to the wayside, but the other ones will pick up the slack. But Visa's got an incredible, just using them for an example, they've got an incredible business model. They're a toll keeper. They get a small percentage of every transaction. Much of the world is still not even fully saturated with credit cards. The business is incredible, as is Costco and Home Depot and Apple and Google. I mean, Google, has just announced, as I speak here, a 20-for-1 stock split. Stock was up $300. Those are the good things that happen when you own these good companies. But most of you, again, just buy the index and hang on to it, because you're going to beat 85% of the money managers and traders that are out there. It's nuts. And pay virtually nothing to run it. 6 basis points for the Vanguard S&P 500. The last thing I'll just talk about quick, people ask me, I get a lot of people asking me about specific funds and ETFs and that stuff. Well, in the back of my book, I give you my portfolio as it was about 6 years ago. But I've talked about this a few times before. What's right for me and my portfolio and the size of my portfolio, where I am, is much different than where you're at. If you're a young person in your 20s, I would be going, having a fair bit of your money going into some tech names, some growth, the Apples, the Amazons, the Googles, the Microsoft. But you may also want to have some stuff that's a little more safe, like a Canadian bank for stability. They call it that barbell approach. You've got a nice dividend there. You're not going to get 100% return, although the Canadian banks have had a nice run here the last 18 months. They're at all-time highs. But you're going to get a nice steady dividend that's going to keep increasing. But everybody is different. But as far as my portfolio, 70% of my portfolio now is in US dollars. 70%. 100% of my RRSP and my TFSA is in US equities. My TFSA now is 100% in tech. And most do not pay a dividend or pay a very small dividend. I've also got Visa in there and Costco. They're more of my growth names, because the dividend in there, if it is a US dividend, is got a 15% withholding tax, which you don't get back. My RRSP is 100% in US equities in US dollars. My Canadian side, or my unregistered funds, I've got about 30% in my Canadian stocks. That's where I hold my Canadian banks and my Bell Canada and my TELUS. My ETF holdings, if it's a US ETF, I hold it in US dollars. A lot of you guys talk about buying the Canadian version of the S&P 500 or of the Vanguard Total Market, VUN, I believe. Those are okay. I don't do that, but might not be like you. The reason why I have a lot of my money, all my individual US stocks and all my US ETFs in US dollars, is because of my situation. My goal and my wife's goal, I spend a lot of time in the United States. I've got family there. I travel there quite a bit. I've been not as much as I'd like to with COVID. But when I'm ready to retire and gradually move into retirement, I'm planning on spending probably about half my time in the United States. Southern California, Hawaii, New York City. And for that reason, I built a portfolio that I want US dividends, and I don't want to be at the whim of the exchange rates. I want to have it where I'm collecting $200,000, let's say, in US dividends. And I don't want to be at the whim of living down in the States and the Canadian dollar crashes and it's a 65-cent dollar. I want to be able to avoid all that and have US income flowing into my US bank account and then run off my US credit card. So that's me, though. You may not have that goal of wanting to spend a lot of time in the US. But I also, lately, with the Canadian dollar being strong, when it is, I take advantage and I buy US dollars. When the Canadian dollar is weak, I do not buy as much US dollars. But again, everybody is different. I'm just giving you my situation on why I hold a lot of US equities. The other thing, of course, you're not going to get proper diversification just being in Canada. You want to get a hold of those US companies, those tech names, and the Johnson & Johnsons, and the Costcos and the Apples. For me, that's where a lot of the growth, and that's pretty much the world's best companies. Nothing wrong, though, for some of you guys if you want to buy the Canadian version of the VIG or the Canadian version of the S&P 500. The only thing, too, is you have a little bit higher MER on those. Instead of 8 basis points, you might pay 20. But hey, they're still fantastic. But again, for me, I'm going to bite the bullet on the currency exchange now, and I'll buy, especially when the Canadian dollar is strong, because I don't want that currency risk for me later on when I'm living in the States. And again, even before I retire, I spend at least probably a month and a half, and I'm always buying product in US dollars and supplements and all that other stuff. So I just don't want the currency hassles. I want to have a nice income to me coming in US currency. So I don't have to worry about the Canadian dollar down the road crashing. Because remember, Canadian dollar goes up and down. It is a petrol currency. When oil prices are high and the oil sands are moving, the Canadian dollar is strong. When oil demand weakens, our dollar weakens. And then, of course, the other thing is I want exposure to these great American companies. Because outside of Canada, outside the Canadian banks, which I own all of them, probably have well over 700,000 just in the Canadian banks. They're one of my biggest holdings. I love collecting those fat dividends, and they've been increasing them to me. But I also own a lot in Bell Canada, TELUS, Shaw, Enbridge, a little bit in Suncor, and then I own XIC, which is the iShares TSX Composite, and I own XEI, which is the Canadian High Dividend, which I also like. I was buying that at COVID. It was yielding about 7%. Incredible. It's had a huge run now. The yield on it is still decent. It's about 3.5. But XEI is a good one, but that's that barbell approach. It's nice, steady income, good dividend. They keep increasing it, and then it's weighted against some of my growth names, the tech and everything else. But everybody is different. No one size fits all. So when you guys ask me about things, hey, maybe that fund is good for you. But that's why when I tell you on BNN, these guys call in about stocks, it's virtually impossible to recommend a stock without knowing the person's situation. A stock that's good for me might be not so good for you. It's all based on your total net worth, your total portfolio, your age, when you're going to retire, where you're going to retire. Are you going to spend your entire retirement living in Canada, or are you planning on spending some time in the United States or Europe and want that strong Canadian dollar or US dollar, or just don't want to deal with currency fluctuations, which I don't. So no right or wrong answer with portfolio, but my book tells you about it. But buy quality, as I always say. But for most of you guys, just buy the index. Some of my favorites for the US are the VIG, Vanguard Dividend Appreciation Fund. I've owned that for probably 12 years. Of course, the S&P 500. I have a lot now in the triple Q, and I've been buying more on that sell-off last month in January. The timing was perfect because I had fresh powder for my TFSA, and I had fresh powder for my 2022 RRSP. Pretty much all of it went into tech. I put a bunch of it straight into the triple Q. Triple Q, just take a quick look at it. The top 10 holdings make up about 50% of it. So it's Apple, Meta, Amazon, Microsoft, Tesla, Netflix. I buy the triple Q when you get a broad market sell-off and I'm busy, just throw some money into the triple Q. But I like those, especially in the TFSA, because it's unsheltered growth, doesn't pay a dividend really, 0.5%, and it's just more tax favorable in there. I'm Owen Bigland. As always, thanks for watching. Thanks to all my new subscribers. I'll see you guys next week.